Hello, this is Mike Swanson with WallStreetWindow.com. I got a very special guest today. I'm speaking with David Skarica, runs the website addictedtoprofits.net. He's a good friend of mine, and we haven't done a video in probably at least 4 weeks, maybe 6 weeks, because Dave took a trip, left the Bahamas and went to Europe, saw what's going on there. So what are your thoughts now that you're back about what's happening in the financial markets and the rest of the world?
I think I came back at the right times. I don't know if you've been reading, but I was in Spain for most of the trip. I was in Barcelona and a few days in San Sebastian. And just so you know, I know everyone's talking about those heat waves. I wasn't really affected by that for two reasons. I was in England too for a few days at the beginning of the trip and then a few days at the end of the trip. And it kind of was around that heat wave. So it was actually cool in England when I was there. And then in Spain, Barcelona just had the same weather every day. It was about 90 and just sunny every single day. And it didn't really fluctuate. It was more like in the center of the country where it had that heat wave, or it got up to like, I think Madrid got up to like 110 degrees or something. And so I wasn't affected by this. But the thing is, now in August, one of the things they're doing because of the energy problems due to the Ukraine war, even though actually Spain gets most of their energy from the Middle East, a lot of it comes from like Libya and Algeria and places like that in Spain. But anyhow, they're restricting the hotels to having, their air conditioning down to 27 degrees, which is like 80 degrees. Which isn't really that cool, right? And I don't know if you have to do that in individual rooms, but I know that it's like, when you walk into the lobby, usually when you walk into a hotel lobby or a big restaurant, those kind of places, or a shop, they tend to be quite air conditioned, and that's what they're doing. And I heard another heat wave is going to hit Spain. So long story short, I kind of timed the trip right being in November because I don't know, like to me, 27, especially when you're inside with no breeze, like that's about 80 degrees. That's not really that pleasant, and I'm not like, I don't have air conditioning on right now in my house, and it's about 90 degrees here in the Bahamas, but there's a nice breeze coming off the ocean. But I'm not a huge air conditioning guy, but definitely at night, like you like to put it up and sleep a bit.
Well, when it comes to the financial markets, I mean, from the time when you from the way things are now compared to when you were gone, it's completely 90 degrees different. I mean, before you were gone, the Dow, the S&P was down like 20%. We had that Ukraine war in the first quarter. Energy prices exploded, gas prices exploded. Inflation was something constantly talked about in the financial media. And since you've been gone, the S&P has rallied 10% off of a low. And a lot of people are seeing signs that this rally is really the start of a new bull market. Jim Cramer said now is the time to buy stocks into the next bull market. Kathy Wood made a similar declaration. And when it comes to the Federal Reserve, a lot of people are comparing the situation now to what happened in April 2020, or more apt, the fourth quarter 2018, when the Fed pivoted in 2018 from being hawkish on interest rates to stopping the rate increases and then cutting in the next year. So a lot of people are looking forward to that, or saying that's what they're predicting. And something similar happened in 2016. So for basically, people are really excited now that you're back, and when you left, it was completely opposite. So what are your thoughts?
And actually, one thing I did in the newsletter in June was that I had like short positions or puts on the big tech stocks, Tesla, Apple, Amazon, that sort of thing. And I didn't get the exact bottom, but I got rid of all those positions. I just had this feeling that it looked like we were going to start to rally, and the sentiment was getting a bit negative. The VIX was in the mid 30s. And to be honest, I'll be perfectly honest with people. Like, the rally has been stronger than I thought. I didn't think you'd see Amazon back at 140. I shorted it around 125, and I sold my puts when it was between about 105 and 110. And I thought, okay, maybe we'll get back to 115, 120. And it didn't interest me re-entering the position. So, and it just shows you the power of sentiment in markets, because like Amazon's last earnings weren't even that good. but it just wasn't as bad as people thought. You get short covering and you get this all this kind of other thing, and you get the momentum, like like you're saying, like that seems to be the driving factor. That Powell talked about something like a neutral rate, and I think all he meant was now that rates are back over 2% on the Fed funds, and he wants inflation to ultimately go back to 2%. That's what he considers to be kind of neutral rate. But people took it into as account that he wasn't going to keep raising rates. But if you go look, and you can put this up on the screen because I was just looking at. But if you go look at
I'll put it up right here. The Fed
funds rate, and I just mentioned to you this is that actually the odds of it being another 75 have gone up a lot in the last week. And by the way, this is why I'm not a perma bear. In 2019, for example, I actually didn't have a lot of shorts. And the reason for that was I just thought that they were pivoting and they were going to cut rates. And the market looked like it had put in a bottom in 2018. And then in 2017, when Trump got in, he was front ending, he was doing a lot of fiscal spending. And I thought that would short term be positive for the markets, right? So, and you're showing this here. So you can see there's a 60-40 chance it's going to be a half a point, but it's still another half a point, right? And then the next rate increase, it's almost looks like another half a point now. Because if you go look at that 325 to 350, that would be a half a point from it. It says 44, but it's also got 8% that is at 350 to 375. So that's really about 52, 53% of another half. And then December is almost 100% of another. Again, the 325, that's 82% basically. No, that's still actually November is still up in the air. Sorry about that. That it would be like, well, if it was 325 to 350, it would mean 225s, which you can see is about 60%, and then maybe another 25. But what we're basically seeing, in the long story short, is we're looking at another 100 basis points by the end of the year. No, I know a lot of people are saying, oh, the 10-year bond, and there's an inverted yield curve, which of course is negative and probably means we're in a recession or going to have a recession. Even they're trying to say this isn't a recession, but whatever, right? I think two quarters of negative growth, that's always been a recession. And maybe we're not in the depths of a recession with the job losses and that sort of thing. That's probably to come. So you can see the 325 to 350, and then there's the March there. So it kind of ends up around 350 to 375. And by the way, that's what I'm looking at. Because another thing I've been looking at is when people think I'm a hawk or a super bear, all I do is, and if you can put this up somehow, either on stock charts or another website, just look at the 2-year treasury. And if you can get a longer term chart of the 2-year treasury, I don't know, go back even 30 years to like 1990, right? And the 2-year treasury always predicts within 25 to 50 basis points of, just go back 20 years, that's fine, because you'll get the last 3 rate cycles that way. You can see it went to like 5.5 in 2005, 2006. And I think the Fed funds went to 5.25. And then, you'll see it better on the, And then it went to like about 3% in 2018. And I think the Fed funds then went to 2.5. So it always goes with between 1/4 and 1/2 point, and if we look at the high being about 325 on this move, you're talking 275, which is that next 1/2 point. So I just think that we're going to go to the 275 to 3%. And that's here's the thing. I don't believe that interest rates, it's like the 70s when people go, oh, inflation is 8%, interest rates should be at 8%. I think because of the amount of leverage in the economy, the amount of government debt, personal debt, housing debt, corporate debt out there, 3 to 4% rates is probably enough to really stymie and kind of crush the economy and slow down inflation. So I think that's ultimately where we're going. And that's the only reason I've kept telling people there's no pivot. And like I said, in 2019, I was like, yeah, I think the market can rally. And me and you were mostly in precious metal stocks. I didn't really participate in kind of like the NASDAQ bubble, which really took off in 2019 into 2021. But that's actually when we both got into Aftermath Silver, was in the summer of 2019. And that eventually went from $8 to $1.50, right? And there were a couple small tech deals I did 2020, 2021 that did well as well. So anyhow, but just to say, I'm trying to say that in late 2018, there was a sign of a real pivot. And you could see the Fed was going to stop raising rates. And actually, even starting cutting rates. And you can see in 2019, they cut rates to about 1.5% from 2.5%, even before they cut them to 0 during COVID. So I don't see any sign of that now. I don't care what Bernanke said, but if you go look at the 2-year Treasury, which always predicts where the Fed funds rate's going to go, and all these other factors, the futures which we just showed, it looks to me like we're going to 3%, and I think the long bond will come up a bit in yield. Now, the problem with the long bond right now, it's not what it used to be in terms of predicting inflation or predicting where rates are going to go, because again, the issue is the government debt. Like, that 2006, 2007 cycle, which we just show, you can see the 10-year bonds went to 5%. We can't have that anymore because the government has so much debt. Debt to GDP in the States was probably 50% then. Now it's 110, 120%. So we can't have 5% interest rates on the 10-year or on the 2-year because the interest expenditure will be too much, and the government will essentially start turning in like what Greece was, or what Venezuela is, or Argentina is. So anyhow, so we can't have that. So I think that's one reason we might get an even more inverted yield curve than usual, because these kind of longer term rates have to stay in line. And even Europe's doing this kind of yield control, which is really strange, where Europe is starting to raise rates as well. But the big countries like Italy, Portugal, Spain, Greece, they want to keep the yields down so they don't go into a debt crisis like they did in 2012. So Europe is this weird thing where they're kind of doing a form of yield control, plus they're raising short-term rates, So so there's this kind of weird thing going on. But I think ultimately, and even more important than rates, is the balance sheet is going to be shrinking. Like, they're not going to be selling assets, but they're just going to like mortgage-backed securities, things like that. When they expire, they just won't like roll them over or purchase them again. And that shrinking balance sheet is shrinking liquidity. And we're already, like, housing prices have kind of lagged. Like, housing prices still showed new highs, as recently as May or June, but I think they're going to start coming down as well, because the Case-Shiller index is 50% above its 2006 top. And I think that's too when you'll see the real, economy kind of being, affected.
When you look at this, when we look at this chart going back to 2003, you see this decline and still below the moving averages, and we're rallying back up to it. Does it look like this is happening? What's going on?
It looks actually, if you can know what I think it really looks like to me, can you
like that?
Can you get the NASDAQ instead of the S&P?
Yeah, sure.
And then can you get the Nikkei in 1990?
Well,
this is actually what it really looks like.
I'll load up the NASDAQ first.
You do the NASDAQ first, because the NASDAQ, I think, is the real bubble type market. One reason the S&P, even though it did fall 20%, and the Dow, they have a lot of energy in them. And of course, energy has been the best performing sector basically to year to date. Now, I'm a short-term oil bear. I actually have been since over 100. I'm not really trading it, but because the oil stocks aren't that expensive. So I don't really want to short something that's not expensive. But I do think this strict monetary policy, and oil is actually below 90 today, can bring oil back down to 70, something like that in the fall. And I think that's actually when you want to buy. Now, if it's a big crash like 2008, you'll even get a better opportunity. Oil could be 40. So I have very little in the way of energy right now. But I think that, okay, so that complex, what I'm trying to show is that first move down, I'll get back to that in a second, the oil thing, but that Comp X is 30% down. And now it's seeing this nice rally. And back in 1990, you can see when the Nikkei first went down, it went from about 40,000 to 28,000 on that first move. Now, the first move was a little quicker. That was 4 months. This move was about 6 months. So nothing's gonna be exactly the same. And then that other move back up took the Nikkei back up to about 34,000. So it took the Nikkei back up about 20% from its lows. Well, you take the NASDAQ 16 to 11, you get to about 13, 14, where it is now. That's the 20% rally. And then you saw that huge move down in the Nikkei, which happened in the fall. So this is actually, because a lot of people like to compare it to 2000 but when I look at all the past bear market busts, and considering that Japan was raising rates all through 1990, so all through when the bust was starting, just like the Fed is now. And it took 4 or 5 months for that first bust to happen. And this one took 6 months. And so it was kind of a longer type decline. It wasn't like 2000 when that first, you might remember this, that first bust in the NASDAQ from late March to mid-April took 3 weeks, So it was like a kind of a longer term bust. And but even the rally, it kind of again looks like that rally in the NASDAQ, which again happened over the summer. So the question to me now is, in this second half of the year, is I'm pretty sure we're going to have another decline. But the question is, do we have a decline that's kind of like the Nikkei, where boom, it just smashes into October, November? That's kind of like 2001 or 2008. Or is it like 2000 where the NASDAQ just kind of grinded and the market grinded lower into the end of the year? If the market grinds lower, I could see that 100 basis points occurring on the Fed funds, 75 to 100. If the market smacks lower into October, November, we'll probably get that 50 in September. And then that would be the last rate hike, So, and that's like kind of where my range is anyhow. I'm looking for 275, 3, maybe 325 on the Fed funds. And I think they're not just going to turn around and cut. I think they're going to pause for a while. And they did that in 2000, by the way. They stopped raising in the summer of 2000. They paused for 6 months, and then they began cutting in January 2001. And then they'll cut. But here's another thing too, is one thing you showed on that 2-year treasury, in the 10 years the same way. This is the first time in 40 years we've had a move where we've now seen higher interest rates than the previous high of the last cycle. We're higher than we were in 2018. I think this is the start of a secular bear market in stocks. And I think that secular bear market is going to is kind of play out here, second bear market in bonds, so higher rates. So I think in this rate cut cycle, we're not going back to zero. I think maybe we go to 1.5%. That kind of puts in the base for the higher high, and then we go higher, because I think the next round of inflation, people think this is bad. That's where it's going to be really bad, because there'll be printing from much higher prices. It won't be like supply driven, kind of like because these issues because of COVID. It will be purely monetarily driven. Like if oil does correct to 70, you're going to be seeing them printing money with oil from 70, not oil from negative, like after COVID. That means oil could go to 150, 200. I really think, and it's kind of like the 70s again, where after inflation slowed down in 75, 76, that second period of inflation in the late 70s was even worse, and then you look at the 40s, the same thing. The first period of inflation happened in the early 40s when the war started. And actually the second period in the late 40s after the war, even though they had, done all the spending, because they had kind of printing money to pay for all the spending from the war, that was worse than the early 40s, the late 40s, And you can see oil here. And look, I know it's nice to be bullish on oil because of the war. And you said there's going to be supply shortages and this and that. But look, you have to be realistic. If oil breaks 85 to 90 here, I could definitely see 65, 70, those support levels back in 2001. And at that, and let's face it, if the Dow or the S&P smashes down to 3,000, on a next wave down, and the NASDAQ goes to 8,000, that's a catalyst for it, right? And last thing, I try to just talk about technicals, but if you look at the consumer right now, there's the most credit cards in circulation since guess when? 2008. What people are doing right now is they're maxing out credit cards to do their trips. My one stockbroker told me I had a couple grand wired to me because I was waiting for some other money to come in and just needed it for some spending cash in Europe. And it took a day or two late because my broker's assistant told me everyone was wiring money out of the brokerage account. So people were either selling stocks or just wiring money, and they're doing it to pay for their vacations. So it's like I think this is kind of the last hurrah. And look at the United States, you guys have been open for basically the last year. Like you did, like a lot of states took off the COVID restrictions, last summer in the States, but a lot of places in Europe and and I'm from Canada, and even here in the Bahamas, we finally got rid of the testing requirements, et cetera, for traveling here. A lot of places were closed up. And so this is like people haven't been anywhere in 3 years. So there is this kind of pent up demand. But here's the funny thing. If you go look at the earnings of the airlines, Airbnb, et cetera, these things, some of the earnings aren't very great. It's because inflation is killing them on the expenditure side, right? On the so they're not having, and I think the market's also looking forward to like, well, this was this big boom this summer of travel, and that's going to kind of end. Another thing too, if people think like I talked about oil going down, oil is going to go down because there's a demand shock and a liquidity shock, and the markets go down, right? Oil is not going to go down because of oil is not going down because of when I say when oil is not going to go down and it's, oh, people have all this money to spend. Like look when oil crashed in 2008 or when oil crashed in 2020, the whole market kind of crashed with it, right? Now, in 2014, oil did tank because a lot of that's when the fracking boom was happening. A lot of supply came on the market and the market didn't really tank. But, for the most part, when you get these oil busts, it doesn't really help the consumer. It's because of demand and liquidity drying up,
Well, the thing about that 2014 is the Saudis are pumping out all this oil to make the price drop, to hurt the frackers.
Yeah.
It was a vicious Saudi operation to hurt the United States.
Yeah. It was like the Saudis did that combined with the increased production from the frackers. So it was like this kind of like, worst of all worlds for oil at the time. And if you go look at it after it bottomed then in 2014, it went right back up too over the next few years. So it's like, one second.
There we go.
I'm just looking at it. You got it up. I'm looking at it myself too on my own screen. Yeah, like when it bottomed, it did go a little lower into early 2016. But again, it went lower. Again, 2016, 2015, if you remember, was about a 15% correction in the markets, right? It was the worst correction we had seen in about 4 or 5 years, and oil fell with that. So again, and then it was back to $70 by 2018. So that I'm not looking at the $30, $40 because again, you have to look at it. And this goes for commodities as a whole. There's a lot different things going on now than 2015, 2016, or 2020. I mean, different backdrops. If you go look at the inventories of everything from copper to oil, this and that, everything is very low, like historic lows. So I think, this rate hike cycle can kill off demand for a little bit, and we can see all these commodities correct. But I think unlike, 2008 or 2015 or, 2020, now we have almost shortages. So I don't think you'll see the depths in that correction in commodities, and then you'll see them come right back up, after that cycle kind of ends, the next up cycle starts. So I think that's one thing to take into account as well. And if you go look at oil, if you went really far back, to like, I don't know, like, to like, sorry, I'm just going back far back, like to like 2000, you'll see during that 2001, 2002 bear market, oil went from about 35 to 20. It didn't like, and at that time, it was a lot lower prices. So like the previous cycle low was like 10. So it didn't really collapse to new lows, even though the NASDAQ collapsed. And that's kind of what I was thinking this cycle. Like, if it does something similar and falls, I don't know, 40, 50% from those highs, you get $60, $70 a barrel. And then it bottoms there and then probably gets set up. And remember, off that low in 2002 of 20, we saw oil get ready to go to 140, 150, So, and I think that's, if we get, again, like a higher low off this cycle, we're kind of setting the stage for the next cycle. And remember too, one thing, when we got those low oil prices of 2016, of 2020, we had the aforementioned Saudis pumping the fracking boom. Right now, like we're not really seeing that drilling return to the frackers, like the energy policies themselves. I'm from Canada, and policies of Canada, the Canadian government are actually really negative towards the oil companies. So you're not seeing these pro-energy policies to create supply. So I think you're seeing that. And of course, they're draining the strategic oil reserves back to like 1985 levels, and they're going to do that into the election in November. And that means after November, they got to, number one, stop doing that, and then number two, start replenishing those reserves, which means demand, right? They're going to have to start buying oil.
Well, in light of everything you've been saying about the outlook you have for the markets, what do you think is the best thing to do for investing and trading?
Well, right now, I don't want to sound boring, but I am very cautious because we've seen this bear market rally. Obviously, for someone like myself who can be a little more aggressive, you can do shorts, you can do all that sort of thing, and you know, am I going to be? I talked about those big tech shorts. I actually recommended. There's actually two ETFs where you can short Tesla and Nvidia, and it's great because you can just short the individual stock. So a few days ago, I kind of recommended to do like a first kind of tranche in those, right? And they've trended lower, but I actually wouldn't mind the stocks went a little higher to kind of slowly average in to that position. So I'm kind of doing that, but really I'm just waiting because, even though I'm a gold bull longer term, the problem I have now is like, I just think, and gold is up a lot today and it's at like a new intermediate term high. It's like, the highest level since like late June, early July. It's just like, if gold is going up because of this perceived pivot, and I don't believe that pivot is going to happen, and I think at Jackson Hole, you're going to see Fed speakers come out hawkish, then it could fall, with the rest of the market. So right now, like there are some junior stocks, and I'm actually going to do, when I restart my newsletter next week, I'm going to do a video on 10 junior stocks to buy now. And a lot of these stocks are near production, et cetera, and they're extremely cheap. So there are junior stocks I think you can start putting your toe in the water in. And there's other stuff, like I'll give you one right now. This is not a junior stock, but like one stock Mike and I actually like, is TKC. That's the Turkish telecom. It pays a huge dividend. And it's gone from, I think the all-time high is like $20. It's like $2 now. It's 236. And I could go lower, as this tightening cycle increases, but, put your toe in the water and something like that. And then the stock drops more, average down. But, things like that you can do. But right now I'm being very, very cautious and just kind of waiting because I lived through 2008. I lived through these cycles. I know, like I used to be a student of Martin Zweig, the don't fight the Fed thing. So I know at some point that's the crazy thing about people being so bullish right now is that you're still in the midst of the biggest Fed tightening cycle. And even though rates went higher in 2006, really this is the biggest tightening cycle since the early 80s because they're doing 50, 75 basis point, tightenings.
Well,
so I think it's markets. I'm just cautious. I wish I could be a little more like sexy or something, but I just think whatever. It's August. For some reason, again, if you look at 2008, 2001, the Nikkei 1990, 2000, in the Nasdaq. A lot of times these corrections tend to begin maybe towards the end of August and then after Labor Day into the fall. So maybe that's something we just need to wait on.
Well, as we wrap up, I'd mentioned that you said you're going to put out some new stuff next week with some new junior trading ideas. And people, I'd say, should go to your website, addictedtoprofits.net, subscribe to get that information.
Yeah, I'm going to start. You'll see, I'll put out a couple of videos more on macro markets, not on individual stocks. There is a stock that Mike and I like right now at, I have a marketing agreement with but I also own it. I really like it a lot, called AMP. And then for those of you, by the way, are accredited investors and can do this sort of thing, they're going to do a financing. Which is actually a pretty good discount to the current price. It's a stock that deals with more like an agriculture and ammonia and fertilizer. And anyhow, I'm going to do a video on just that company itself because I think it's a really good opportunity. And but then, like, if you kind of want access to the other ones, yeah, I'm going to close up the newsletter because I've had it free for a number of years now, and I've decided to restart the pay subscription service because I think things are so cheap and there are so many good opportunities. I want to start doing that again. And anyhow, so I'm looking at that stock, and then on top of that, I'll have a whole bunch of junior stocks. Like like there are so many stocks out there that now have like $10 million market caps, $8 million market caps that are near production juniors. So they're going to have cash flow. And I just, like, I'll give you an example. There was a company called Avion Resources. I'll give you two examples actually. And Desert Sun, both run by the same group, by the way, by a guy named Stan Barty. And by the Amp, his son is on the board of that company, right? So Avion took over an old property from Nevsun in Africa, and then it crashed to 6 cents during the financial crisis. And they did a little financing of 6 cents. I just bought it in the market at the time because I wanted to stay liquid, and I recommended it in the newsletter. And Avion went from 6 cents to $2, and eventually was taken over around 90 cents by another company. And then Desert Sun, another one of Stan's deals, again at kind of the bottom of the market in 01, 02, he took over the Jacobina mine from one of his previous companies, Williams Resources, spun it into Desert Sun at around 20, 25 cents. And the stock went to $5 or $6 and was taken over by Yamana. And it's actually one of Yamana's top producing properties right now. And I think Yamana just got taken over as well. You know, for I think, and that was north of $500 million. So what I'm trying to say is you get these near production properties in these kind of downturns. That's where, because then the cash flow starts, they start making money. That's where you get a lot of leverage in the next move higher. So I'm gonna have companies like that. Like a company I like is Galani Gold, which actually is up a bit today, but it's really depressed right now. But same thing, that stock I think was down to 3 or 4 cents in 2019, and it went to 40 cents during the last cycle, you know, and it went back down to 7 cents, by the way. Now it's about 10 cents. So again, Galani is actually a production company, by the way, but Galani back in 2019 was near production, and then it went up tenfold. So these are the kind of companies you can make 10, 20 times now, you know, and they get down to these $5-10 million market caps, you know, in the next junior cycle. And I think that's why it's a good time to kind of relaunch my letter, because now I actually see these opportunities. And well, me and you were doing finances, we did well on a lot of deals. I don't think you saw the extreme in value that you saw. Now, this is probably the last time we saw this was about 2015, 2016, you know?
Yeah, it's that Galani stock. Didn't realize it had gotten so cheap. Wow.
Yeah, and that thing's in production, by the way. They produce they don't have huge production, but they're producing close to 45 to 50,000 ounces a year. So it's like, again, that's the kind of stock, like, you know, and they're still doing well at $1,800-$1,900 gold. So, you know, I think if you get gold north of 2,000, again, these things will really take off. And one thing too, the opportunity you're getting, this is the last thing here, you know, the market has bounced, you know, we have seen this decline in the market for the most part. You know, remember the S&P is still 41, 4,200. It's still, I think the high was 47, 4,800. Like, you know, it's still 12, 13% off its highs. So you're still, and liquidity dries up. That's usually bad for the juniors. So that's why I'm being patient though, because two things, you're probably going to get tax loss selling the next 4 or 5 months, you know, to the end of the year. And then if you get another leg down in the markets this fall, you could even see, like, you know, I remember seeing some juniors go to a couple pennies and you'll be able to just kind of scoop them up at you know, those kind of prices. And even if the company doesn't turn anything, if you got a 20-cent junior that falls to 1-2 cents after the tax loss selling season's over, you can usually get a bounce just to 5-6 cents, you know. And it may not be a huge position, it may be a few $1,000s, but even if you're super rich, hey, who's gonna thumb their nose at making a quick 10 or 20 grand, right?
For sure.
You know,
for sure.
so you know, that's the kind of thing that you'll be able to do, I think, in the third or fourth quarter of this year. And actually, last thing, I know I've talked a lot, but here's another interesting thing about gold. And I think we will see this near the end of this rate hike cycle and decline in the markets. If you go look what happened in 2018, gold began to rise, you know, in like November, December of that year, even while the market was kind of cratering. And that was before the Fed pivoted, by the way. The Fed didn't pivot till around just after Christmas of 2018. So I think gold will start to sense that. Now, maybe the bottom is already in. Maybe gold will hold up in September, October, if there is another move down in the markets. But that's something to really watch. Even in 2008, when gold stocks crashed with the market, again, go look at what happened from about November 2008 to March 2009. when the S&P had a last move lower from about 1,000 to 666. Gold and gold stocks rallied. The HUI, after falling from 500 to 150, rallied 100% to 300 during that last move lower. So gold usually turns up, and actually in a loosening cycle, like 2018, like 2019, like 2015, 2016, or 2016, when the Fed kind of did pivot then too, they stopped raising rates for a bit. Usually in that cycle, we saw it again like 2003, 2000, gold the first year or two, 2008 to 2011 was an example of that. For whatever reason, gold and precious metal stocks, 2020, 2021, it's also a sign of that in the first half of 2021. In the loosening cycle, they tend to lead the market. Now, later on in the cycle, as people become more into risk assets, they start to lag. But early in the cycle, the gold and precious metal stocks tend to lead all those all of those kind of markets. And if a perfect example is when the market was kind of flat, like 78, 79, gold stocks boomed 78, 79 into 1980.
Yeah, that's going to be something I'll be watching for real closely as the rest of the year unfolds. Well, thanks for taking the time to talk to me and everyone else. And it's great to see you, and talk again soon.
Yeah, thanks for having me.